The Bank of Canada, second in command, referred to the country's banking system as an oligopoly, highlighting how limited competition is hindering growth here. My next guest argues the trend towards fewer banks actually contributes to a healthier banking system. Let's go to Kai Lam. He's Chief Investment Officer at JCIC Asset Management. Kai, thanks for joining us today.
Thanks for having me.
What's your take on the comment by Carolyn Rogers on the need for more competition in banking?
I mean, look, it is roughly an oligopoly, but when we look at other countries and how many banks there are, whether we look at Australia or through Europe, whether it's like Italy, Spain, France, Germany, the number of banks that we have in Canada is not really any different in terms of size. And really what we've seen over time is more consolidation to have like a healthier banking system that's strong, because that's really important. And obviously during the financial crisis, that was an advantage. There's nothing wrong with more competition, and we do have some. For example, like Global Bank is a challenger bank in Canada, but I don't necessarily agree with the comment saying that it's the oligopoly structure that has kind of limited productivity growth in Canada.
I want to get you on another story we're talking about today. The U.S. Commerce Secretary dismissing the idea of an auto deal with Canada. What do you see as the effect so far of the lack of sort of a comprehensive deal on autos right now, and then the longer term effect if this is the case moving forward?
I mean, I do agree that having an integrated supply chain across North America is positive for the auto sector, and that it does make it more competitive and efficient. That said, one of the challenges in autos is we actually don't have any exposure to autos because of this kind of tariff uncertainty, or how it's going to work going forward, as well as the demand hasn't been that great. So it'll be something we'll continue to watch for opportunities. But right now, it's hard to invest in that.
Is it something that you did invest in before?
A little bit, but it was quite a while.
Okay. Let's get to a few of the stocks that you do like. We'll start with Gildan, which is buying Hanes. What is your outlook on that deal that's moving forward?
Yeah, we really like the deal. We owned Gildan before the deal was announced. We liked it for the growth that they were going to deliver and the improved efficiencies of the business. But then after they announced the acquisition of Hanes, it really expands their ability in the innerwear market. And I think the $200 million of synergies that they announced are conservative. And so they should be delivering over 20% earnings growth in the next few years. And yet right now, consensus is not looking for that earnings growth. And I think valuations are still attractive. So we do like the deal.
Are there tariff issues for either of these companies?
I mean, there are some tariffs, but speaking with the company, it sounds like they have a high enough U.S. content to kind of mitigate the big tariff risks.
Okay, let's get to Tencent Holdings, which is another stock pick for you. It's a Chinese stock. Tell us about it.
It is one of the biggest Chinese stocks. They have a few strong businesses. One, gaming is doing really well with a game like Delta Force or Honor of Kings and Peacekeeper Elite. They also have 1.4 billion users in their WeChat platform, which is like an ecosystem that's a super app. And we also like that they're investing a lot in AI, both AI cloud services, as well as using it as a tool for further growth. Now, obviously, we've seen a lot of attention on AI names globally, but with Tencent, it's a bit of a second derivative where a lot of these companies are expensive, but these Chinese companies are still not there yet. The valuations are still quite attractive.
Okay, good to know. Gold has been on a tear, of course, this year. Are you still putting money into gold, or are you trimming at this point?
We actually have been. We still like gold, and we did add a bit to it. Obviously, it's benefited from the weak U.S. dollar, but we're also seeing a lot of central bank buying as they diversify their reserves, and to see it as a store of wealth. It does well as an inflation hedge. It does well when geopolitical risks are high. And then right now it has a lot of momentum. And so then it is contributing to Canada's significant performance this year. And we think that it can continue.
All right. Kai Lam is Chief Investment Officer, JCIC Asset Management. Thanks for joining us today.